Let's look at this CGT in a little bit more detail. Take us through the actual implications for individuals first, Carl, and then for companies.
Certainly. Well, if you look in the case of individuals, the inclusion rate has gone from 25% to 1/3, 33%. So in essence, what that means is that if you look at individuals, got a maximum marginal tax rate of 40%. Any capital profit or gain that that individual makes on disposal of a capital asset will then be subject to tax on 1/3 of that capital profit at the maximum marginal rate. So, if you like, an effective maximum tax rate on capital for individuals of roughly 13%.
And then from a company perspective?
From a company perspective, well, the inclusion rate has gone from 50% to 2/3. So what that in essence means, if you take the corporate tax rate of 28%, so again, on a capital profit that's made, 2/3 of that capital profit will be taxable at the rate of 28%. So it's an effective tax rate of around the 18% mark.
And the CGT higher in other markets is the defence on that move.
Well, that is defence, yes. I mean, it's quite correct that capital profits are, in other jurisdictions, are taxed at the same rates as revenue.
So it's really bringing us in line with international practices?
Well, to some extent it is, but practices differ from country to country. The important thing to remember is that South Africa is a relatively high inflation country, and what we don't have in this country is a basis adjustment for inflation. So if you like, reducing the capital profits that you make on the disposal of capital assets for inflationary effects, which is the case in certain other jurisdictions.
Let's talk about infrastructure spend and the actual execution of that infrastructure spend. 260 billion rand was tabled in the previous budget. 178 billion of that was actually spent, which is some 68%. Do you think it's going to be different this time around?
You know, I think some fundamentals need to change for it to be different. You know, if you actually speak to the private sector construction companies, their biggest concern is that government's actually not awarding all the tenders. They're not scoping the tenders, not actually awarding them, the jobs not actually starting and getting done. And it's coming back to lack of capacity, certainly in many areas, in terms of awarding of these tenders. And unless government actually gets the projects on the ground and gets them started, there's going to be a problem with this infrastructure spend. And you know, that is the backbone of the State of the Nation address, and indeed the future growth and employment policies for South Africa are based on the infrastructure spend. So this is a very substantial issue. You know, we obviously have missed a significant part of the mining boom because of the fact we've been unable to get our goods out of the country, and the President clearly tabled a significant number of railway infrastructure build in order to link up these resource-rich areas with the ports to get the goods out of the country. And we actually need to see these infrastructure builds taking place sooner rather than later. You know, one of the reasons why we actually see this apparently delayed period and actually reduction in the public sector borrowing requirement from 7% to 5% is that the infrastructure build, it says in this budget speech, only really picks up in the period thereafter that. And that's a bit of a worry. We would like to see it really picking up now.
Mohammed, of course, the CEOs of the construction companies all looking at this budget and saying, is that public spend going to come, public sector spend going to come to fruition? It could move the construction stocks in South Africa. Do you believe that it will? Have we got enough on this front?
Bronwyn, I mean, already if you looked at the State of the Nation address, I mean, a lot of interest started to come back into that construction sector. We saw a lot of those counters being snapped up by some of your deep value managers in terms of it being a deep value play. And at this point in time, I really think it's quite critical for the market to see that some of this is really starting to come on stream, that there's actual delivery on a lot of the talk that's been out there, and Annabel's actually mentioned that. Until we start seeing things getting implemented, seeing the projects actually being scoped, and actually having that money drop through to the ground, the market's going to potentially need a little bit more of convincing before we actually see a real catalyst being lit underneath some of those construction stocks.
Carl, more clarity on tax relief in special economic zones. Is this good news for us?
Well, it is good news. We don't have a lot of detail at this point in time, but reduced corporate tax rates.
That does seem to be a theme within this budget. There's not a lot of detail.
Well, yeah, as I say, the devil lies in the detail, and that's what we've got to look out for. But as I say, it really is good news. It's something that we've needed for a long time. And it will really make us competitive in terms of attracting the necessary investments into manufacturing in particular that we need.
But we need more clarity.
But we need more clarity,
more
absolutely.
detail before you can actually take me further on that. Public sector borrowing, that was a line item that you focused specifically on. Are you happy?
Well, you know, it says specifically that you have this reduction of the public sector borrowing I mentioned from the 7% to the 5% over your MTF period, and then it rises again as infrastructure program of government accelerates. Now, obviously that reduction is obviously going to be on the back of the program not running as fast perhaps as it could, and this massive acceleration, you know, in the later years probably feeds into that 3.2 trillion we were talking about earlier. So again, you know, lack of detail and not complete clarity is making it a little bit difficult to build your growth forecast. We certainly are looking for GDP growth in the South African economy to accelerate by 4% and then 5%, you know, in 2-3 years out. But at the moment, I think we're going to still
You're sitting
be
with
stuck
what,
by the
2.7% in line with what they're projecting GDP growth?
We had 2.5%, so it's close to the 2.7% for this year. Next year, we've got about 3.5 again close. But what I'm saying is the 2013 to 16 period, we moved from 4% to 6%, and that's going to be that acceleration on the back of the infrastructure drive. But again, you know, we'd want to see the details so we can actually assess where the government's getting the spend going on infrastructure.
Well, we head into a short break. We'll be back shortly to continue our post-budget analysis.